Imagine owning a piece of Apple or Tesla with just $10. Sounds unbelievable? It's not. Investing isn't just for millionaires or Wall Street experts. You too can start building wealth today. It's easier than you think, and you don't need a fortune to begin. Think about it. For the price of a fancy coffee, you could be on your way to financial freedom. Investing allows your money to work for you, growing over time and securing your future. No more watching your savings dwindle away. This isn't about get-rich-quick schemes, it's about making smart choices for long-term financial well-being. This is your chance to take control and build a brighter future. This video is your roadmap to investing success. We'll break down complex concepts into simple terms, guiding you every step of the way. We'll explore why investing is crucial, how to get started, and the pitfalls to avoid. No more feeling overwhelmed or intimidated. By the end, you'll be equipped with the knowledge and confidence to begin your investing journey. Ready to unlock your financial potential? Let's dive in and discover the world of investing together. You might think my savings account is safe. Why invest? Savings accounts offer stability but come with a hidden threat: inflation. $100 under your mattress stays $100. But inflation means it buys less over time. Your money's value erodes. Investing helps outpace inflation. It allows your money to grow faster than inflation. This means more purchasing power and faster financial goals. Savings accounts might feel safe but lose value. Investing protects and grows your money. This is where things get really exciting. Investing introduces you to the magic of compound interest, a force that can turn small, consistent investments into significant wealth over time. Imagine a snowball rolling down a hill. It starts small, but as it rolls it picks up more snow, growing larger and larger with each rotation. Compounding works similarly. When you invest, you earn returns not only on your initial investment but also on any returns those investments generate. Essentially, your money starts earning money, and then that money earns even more money, creating a snowball effect that can lead to exponential growth over the long term. Even small contributions, consistently invested over time, can yield impressive results thanks to the power of compounding. This is why starting early, even with a small amount, is one of the most significant advantages you can have as an investor. Think of time as your secret weapon in investing. The earlier you begin, the more time your investments have to grow. This is crucial for younger investors. Starting early gives your investments a longer runway to grow. Imagine two individuals aiming to retire at 65. Person A starts investing at 25 while person B starts at 45. Person A will likely retire with a larger portfolio. This is the power of time in investing. The sooner you start, the more time your investments have to grow. Investing isn't just about accumulating wealth. It's about creating opportunities and securing your financial freedom. It's about achieving your dreams, whether buying your dream home, retiring comfortably, or leaving a legacy for future generations. By investing wisely and consistently, you're taking control of your financial destiny and building a brighter future for yourself and your loved ones. Imagine having the financial security to pursue your passions without worrying about money. Imagine being able to retire comfortably, knowing your finances are well taken care of. Investing empowers you to turn these aspirations into reality. Investing is a journey that empowers you to take control of your financial future. It's about building a solid foundation for yourself and your family, opening doors to new opportunities, and ultimately living life on your own terms. Before we jump into the exciting world of investing, let's break down some common terms that might seem intimidating at first. Think of it like learning a new language. Once you understand the basic vocabulary, it becomes much easier to navigate the conversation. Don't worry, we'll use relatable examples to make these concepts crystal clear. We'll start with stocks, bonds, and ETFs, three fundamental building blocks of investing. Understanding what these terms mean and how they work will lay a solid foundation for your investing journey. Remember, investing doesn't have to be shrouded in complex jargon. Once you grasp these key terms, you'll be well on your way to making informed investment decisions. Stocks. Owning a slice of success. Imagine your favorite pizzeria. Instead of just buying a slice, what if you could own a tiny piece of the entire restaurant? That's what a stock represents, a small ownership stake in a company. When you buy a stock, you're buying a slice of that company's future. A company's stock price is influenced by its performance and market trends. If the company does well, its stock price goes up, and your investment grows. Conversely, if the company faces challenges, its stock price might decline. Investing in stocks allows you to participate in the growth of companies. Bonds, lending for steady growth. Let's say a friend needs to borrow money and promises to pay you back with interest. That's the basic idea behind a bond. When you buy a bond, you're essentially lending money to a government or corporation. In return, they agree to pay you back the principal amount plus regular interest payments, known as coupons. Bonds are generally considered less risky than stocks, as they offer a fixed rate of return over a predetermined period. They provide a steady stream of income and can be a valuable addition to a diversified investment portfolio, especially for investors seeking stability and income generation. Bonds act as a stabilizing force within a portfolio, offering a balance to the potential volatility of stocks. They can help preserve capital and provide a predictable stream of income, making them suitable for more conservative investors or those nearing retirement. ETFs, your ticket to diversification. Imagine an amusement park with thrilling roller coasters, enchanting carousels, and captivating shows. Instead of choosing just one ride, what if you could buy a single ticket that grants you access to the entire park? That's the beauty of exchange-traded funds, or ETFs. ETFs are like baskets of stocks or bonds that track a specific index, sector, or theme. For instance, an S&P 500 ETF holds stocks of the 500 largest publicly traded U.S. companies, providing instant diversification with a single investment. ETFs offer a convenient and cost-effective way to diversify your portfolio and reduce risk. They're like having a personal investment manager who bundles together a collection of assets, giving you broad exposure to different sectors and asset classes. Before embarking on any journey, it's crucial to have a clear destination in mind. Investing is no different. Setting clear financial goals is paramount to creating a roadmap for your investment journey. These goals will shape your investment strategy, determine your risk tolerance, and guide your decision-making along the way. Think about what you're saving for. Is it a down payment on your dream home, a comfortable retirement fund to enjoy your golden years? Perhaps it's funding your child's education or achieving financial independence earlier than planned. Whatever your aspirations may be, clearly defining them is the first crucial step in your investing journey. Once you've established your goals, you can tailor your investment approach accordingly. For instance, long-term goals like retirement might warrant a more growth-oriented portfolio with a higher risk tolerance, while short-term goals like saving for a down payment might necessitate a more conservative approach with lower risk investments. With your financial destination in sight, it's time to choose the right vehicle to get you there: a brokerage account. Think of a brokerage account as your investment command center, providing you with the tools and resources to buy and sell investments like stocks, bonds, and ETFs. Fortunately, numerous user-friendly online brokerage platforms cater specifically to beginners. Platforms like Robinhood, Fidelity, and Vanguard offer intuitive interfaces, educational resources, and low or even no-fee trading, making investing accessible to everyone, regardless of experience or account size. When selecting a brokerage platform, consider factors like fees, account minimums, investment options, research tools, and customer support. Research different platforms, compare their features, and choose the one that aligns best with your needs and preferences. Remember, the best platform is the one that empowers you to invest confidently and comfortably. You've set your financial goals, chosen your brokerage platform. Now it's time to take the plunge and make your first investment. It's natural to feel a mix of excitement and apprehension at this stage, but remember, even small steps can lead to significant progress over time. You don't need a fortune to start investing. Even a small amount, consistently invested, can make a difference. A great starting point for beginners is investing in a low-cost, diversified index fund, such as an S&P 500 ETF. As we discussed earlier, an S&P 500 ETF tracks the performance of 500 of the largest publicly traded U.S. companies, providing instant diversification with a single investment. Remember, investing is a marathon, not a sprint. Start small, gain experience, and gradually increase your investment amounts as you become more comfortable. The most important step is simply to begin. Imagine setting your car on cruise control, allowing it to effortlessly glide along the highway while you enjoy the scenery. Automating your investments can feel similarly liberating. By setting up automatic contributions to your investment account, you ensure consistent investing without having to remember to manually transfer funds each time. Most brokerage platforms offer automatic investment plans, allowing you to schedule recurring transfers from your checking account to your investment account. You can choose the frequency and amount that aligns with your budget and financial goals. Automating your investments not only enforces discipline but also takes advantage of dollar-cost averaging, a strategy where you invest a fixed amount at regular intervals, regardless of market fluctuations. This approach helps to mitigate the risk of investing all at once, especially during periods of market volatility. Investing is like navigating the open sea. There will be calm waters and turbulent storms. The key is to stay the course and not let emotions dictate your actions. Focus on your strategy, diversify, and stay informed. Patience and discipline are your allies in reaching your financial destination. Beginners often try to time the market, jumping in and out based on predictions. Even professionals struggle to predict market movements consistently. The market is influenced by many factors, making timing difficult. Often by the time you react, the market has already adjusted. Focus on consistent investing over time. Remember dollar-cost averaging? It helps you ride out market ups and downs. This approach mitigates risk and keeps you invested. Diversification. Don't put all your eggs in one basket. Imagine putting all your money into a single stock, convinced it's the next big thing. While it's possible to strike gold with individual stock picks, it's also incredibly risky. If that one company falters, your entire investment portfolio takes a hit. Diversification is the key to mitigating risk in investing. Think of it like this. Instead of putting all your eggs in one basket, you spread them out among several baskets, reducing the impact if one basket were to fall. In investing, diversification means spreading your money across different asset classes, like stocks, bonds, and real estate, sectors such as technology, healthcare, and energy, and geographies including domestic and international markets. This way, if one area of the market is underperforming, other areas can potentially cushion the blow. Emotional investing, riding the roller coaster. Investing can be an emotional roller coaster. When the market is soaring, it's easy to get caught up in the euphoria and make impulsive decisions like chasing after high-flying stocks that might be overvalued. Conversely, when the market plummets, fear can set in, leading to panic selling and potentially missing out on long-term gains. Remember, investing is a marathon, not a sprint. Short-term market fluctuations are normal and should not derail your long-term investment strategy. Instead of reacting emotionally to every market swing, focus on your financial goals. Stay disciplined with your investment plan and remember that time is your greatest ally in investing. If you find yourself tempted to make an impulsive investment decision, take a step back, take a deep breath, and remind yourself of your long-term goals. Remember, successful investing is about making rational decisions based on your financial plan, not letting emotions dictate your actions. Reaping the rewards. Congratulations! You've now taken a crash course in the fundamentals of investing, armed with the knowledge to embark on your own wealth-building journey. Remember those dreams we talked about: financial freedom, a comfortable retirement, leaving a legacy for loved ones. They're well within your reach. Investing isn't just about numbers and charts. It's about taking control of your financial future and turning those dreams into reality. It's about planting seeds today that have the potential to grow into a bountiful harvest for years to come. Remember, the most important step is simply to begin. Start small, stay consistent, and let the power of compounding and time work their magic. The journey might have its ups and downs, but with patience, discipline, and a well-defined strategy, you're setting yourself up for a brighter and more secure financial future. Join the journey. As you embark on this exciting adventure, remember that you're not alone. Countless resources are available to guide and support you along the way. Don't hesitate to seek advice from financial advisors, explore reputable financial websites, and connect with other investors to share knowledge and experiences. If you found this video helpful, give it a thumbs up and share it with friends and family who might also benefit from this information. Let's spread the knowledge of investing and empower others to take control of their financial well-being. Now I'm curious to hear from you. What's the first stock or ETF you're considering investing in? Share your thoughts in the comments below. I'd love to hear your ideas and continue the conversation. Remember, the best time to start investing was yesterday, the second best time is today. Happy investing.